Live with the amazing Emily Cadmore, I beg your pardon, from Fairstone Financial. We've been working with Emily for many years, and this show's called Isolation Inspiration. She's a great mortgage broker, so we've got lots to talk about there. But also, I'd like to talk about you personally, because I think, there's lots to talk about there too. First thing I've got to start with is obviously the disclaimer, because we're talking about mortgages. So we'll begin by saying no advice is provided, and it's for information purposes only that we're giving you this information. So I hope you enjoy it. Emily, let's talk about you first of all. Now, Emily's a broker we've been working with for many years. I think she's the best in the business. Absolutely incredible broker. Never given bad advice to a client. Always on hand to answer questions, and always has the patience and tact of a saint, which I think is a quality of any good mortgage broker. Also, on top of that, she's married to a mortgage broker, so she never gets away from this business. Incredible. But one of the other things I know she wouldn't want to talk about, but I'm going to mention anyway, is that she's a really fast runner. And I think you automatically qualify for the
London Marathon,
aren't you? You're so fast.
Well, that's a nice introduction, Ken. I'm very happy with that. Thank you. No, I would say I'm not super fast, but I have done 5 marathons, and it's a marathon, not a sprint in my book, Ken. But I've done five London marathons, one every other year. Last year being my last one, because the age is preventing the faster times these days. But I did qualify for a good for age time twice, so I was quite pleased with that.
Yeah, I remember.
But my absolute highlight was, I think it was 2019, so 2017, I was running for the Heads Together charity, the mental health one that was being sort of spearheaded by William, Kate and Harry. And on my way round, I managed to sort of do a quick take on the side when I saw a big sea of people doing the charity supporting for that charity. And who did I see but William and Harry? And I did an about turn, ran back, shouted and waved in Harry's face, and ran on again. Apparently Kate was right there in front of me as well, but I was all about the boys then. And when I finished, rather than saying I'm so pleased with my time, but I met Harry. So that was my highlight then.
And just before we start getting into the mortgage and the technicalities, can we meet your cat? I think everybody needs to know Gilbert.
My office manager, yes. Gilbert.
You've got to see this cat, folks. It'd be worth the wait.
Gilbert's come out of his box. He has dressed up. Gilbert, say hello.
Look at that. He's dressed up for us in his bow tie as well. Amazing.
He likes to make an effort. Smart at all times. He's a Battersea rescue boy.
Ah, lovely. What is he?
He's a Persian.
Yeah, beautiful.
It was wandering the streets of Hounslow, but he's now joined the mortgage family.
Oh, that's lovely. Right.
I'll let him go back. You want to go back to your box, baby? Say hello to everyone.
Right, let's talk money. Now, I know everybody's, obviously it's really a good time to talk about this, because we've just opened our doors again as estate agents. House moves are taking place. Lenders are changing criterion. It's a really good time to have this conversation, Emily. So I'd like to start by saying, how are homeowners being affected by the change in the mortgage market right now?
Well, with homeowners, with the mortgages that you already have, it's not being that difficult to remortgage if you have a low loan to value mortgage. And remortgage means you're switching from your current lender to another lender, because lenders have been carrying out desktop valuations, which we'll come on to in a moment, desktop valuations where possible, where a surveyor doesn't have to visit the property. That's generally fine. The surveyor will make a decision. The surveyor and the lender will make a decision as to whether that's feasible or not in each individual case. If it's a standard house and somebody's borrowing 60%, 75% of the property valuation of the property value, then it's likely they will be able to do a desktop. If it's a higher loan to value or a flat, generally lenders have sort of put the valuations on hold, although it is sort of moving now that they're looking at higher loan to values. And there was the announcement today, I believe, that actually when I was on another call there, I saw something pinged up from Nationwide saying that surveyors are allowed to visit properties again as long as it adheres with all the safety rules. So again, that's not going to work in every case. So that's from a remortgage point of view, but often it's and even before lockdown, often it was better for somebody to just stay put with their current lender and switch over to a new mortgage product with them. There's no point in switching to another lender if it's more cost effective to stay put.
How would they do that, Emily? What would be the procedure for an existing borrower to approach their lender?
Well, come to me, come to a mortgage advisor, because actually lenders will now, they've recognised the importance of getting advice in the mortgage industry. So rather than just saying come to your broker, do that, and they'll suggest either moving to another lender or going directly to your current lender, nearly all of the lenders now will allow us as brokers to organise the rate switch on the client's behalf, which is a really straightforward process. If no changes are being made and you're just doing a like-for-like switch, the benefit of that is you get the full research that's been carried out by myself to make sure you are getting the best deal. Everybody's got a different cut-off point, but say you're going to save 5 or 10 quid a month by switching, some people would say, no, that's not worth it really. If you're going to save yourself 50 quid a month switching over 2 years or 5 years, probably is going to be worth it. So you get a proper review of what the best rates are out there to suit your personal circumstances, which is really important, because often I'll have a chat with somebody and I'll say, yeah, well, my mate got this rate. I'll say, yeah, but how much how much equity has your mate got? You might have 10% equity, they might have 50% equity. You don't know, everybody's individual circumstances are different. But if it's worthwhile just staying put with your lender, there's no underwriting, there's no valuation needed. They'll base it on an indexed valuation figure that they actually have on their system, which is often beneficial, actually. Some of the index figures come back surprisingly high. It can work the other way as well, but generally they do tend to be higher. Obviously, they don't take, if you bought your house 2 years ago and you've done a lovely extension at the back and added a loft conversion, it's not going to take that into account. But for a lot of people, an index valuation works well. And it's a really straightforward process. And we don't charge a fee to do that because the lender will pay us commission. So it's sort of a win-win.
The other thing I'd like to mention at this point is, because your industry, like ours, is full of jargon. And one of the real key words I think that we need to talk about and explain a little bit around is redemption penalty, because that's really important in the context of what we're saying now, isn't it? Can you talk about, explain what a redemption penalty is and why we've got to be wary of it?
Yeah, so it's worthwhile always, if somebody comes to me and says, oh, I've got a rate of 2.5% with X lender, let's say Santander, and they say, you could get me a rate of 1.5% with Halifax, for example. The key, yes, that is the case, but is Santander going to charge you anything, i.e. the redemption penalty for moving your mortgage to the new lender? The redemption penalty will apply if you, in nearly all cases, not all of them, but nearly all cases, if you've got a fixed rate, there will be a redemption penalty that will apply if you repay that mortgage to that lender before the end of that fixed rate. And that is what a redemption penalty is.
It will generally be a large percentage as well, won't it, Emily? It'd be quite
it depends. It depends on the lender. Some of them have it sort of moving downwards. So say you've got a 5-year fixed rate, it would be 5% in the first year, 4%, 3%, 2%, 1%. Other lenders will have it running at 5% for the full duration of the fixed rate.
And that's 5% of the total loan, isn't it? The total loan.
Exactly. Of the total sum that you'll be paying. Exactly. So 5% of the total loan. So it's rarely, again, not always, and one should always consider individual circumstances, but it's rarely cost effective to pay an early repayment charge in the middle of a fixed rate to move to a lower one. Although there have been some where it's cost the client, I don't know, maybe 10 grand as an example, but they're saving themselves. They've got another 3 years left of their high 5-year fixed rate, and they're saving themselves £8,000 a year. So
right.
it's worthwhile looking at cases, and it's quite an easy calculation to do.
Two quick points. Number one, anybody that's watching that wants to ask a question, we are live. Please do ask your questions. Just mark it on the comments and we will see it come up. And Emily would be happy to help you, I'm sure. Second thing is, Emily, the big thing now has been payment holidays, hasn't it? Because of COVID. So could you talk a little bit about what that means? Because I think a lot of people are anxious about this and are not sure what a payment holiday is.
Yes. So again, this is one where you should always check directly with your lender. But since the lockdown has started, and obviously there are a number of people who are not in a financial position to continue their mortgage payments, the lenders have been assisting and have generally been offering the option of a 3-month payment holiday. That's where we were. I think it was the beginning of April. So end of March, beginning of April. So it's fine to do that. It won't. The lenders confirm that it won't affect lending in the future. Although, if you do have any concerns, I would always suggest you do check that with your lender first.
Do you believe them, Emily?
Sorry?
Do you believe them when they say it won't affect your credit rating?
I have personally taken a mortgage payment holiday on one of my buy-to-lets because my tenants can't pay. So I personally am comfortable. Each individual is different, but it's the lenders trying to assist people during this difficult period. And obviously there are a lot of people who just simply cannot work and don't have the finances to maintain their mortgage payments. The thing to be really mindful of, though, it is a mortgage payment holiday. It's not 3 months not paying your mortgage.
It's not free money, is it?
No, it's not free money. And the understanding is that the lender will calculate, what you haven't paid and then add that to your payments in the future. Again, none of us have had actually any paperwork. Can you imagine the amount of people who've requested payment holidays?
Yes.
It's near on impossible to actually speak to somebody specifically about your individual case, and they haven't started to issue any paperwork as yet, as far as I know. But it's bearing in mind, only take it if you need to take it, and it will have to be repaid.
And I think particularly from my business point of view, as you know, you and I have had discussions about this. Some tenants have said, well, landlords are getting payment holidays. I want a payment holiday. And then you have to explain that actually all that's happening is that the money that they're, if you like, getting away with is just being loaded onto the loan, meaning they have higher repayments further down the road, isn't it?
Exactly. And I think that's what, as you said, the conversations we've had about this is that, yes, there are some tenants who are unable to pay their rent as well, and everybody's in a difficult position currently, and everyone's trying to make it work and just be humane about the whole thing. But if you are a tenant and you're taking a payment holiday, you will need to be thinking about how you're going to pay, or come up with a plan as to how you are going to pay back that money that you haven't paid to your landlord, because they're going to have to do that for their mortgage.
Exactly.
So it's everybody working together, trying to be reasonable, ending up with the result that nobody's there without any food in their fridge, but equally mortgage payments are going to be met eventually and landlords are going to be paid.
Now, the other thing is that it seems to me, whenever I look at the mortgage rates, every time I seem to look in the paper every week, I check the rates. They seem amazing. They seem really low right now. But I understand a lot of the big lenders have withdrawn the high loan to value loans. Is that your experience, or are they going to come back? What are your thoughts?
When this first, so again, things are changing, not even weekly, day in, day out. When this first happened, most lenders sort of stopped doing any business above 75% loan to value, and some cut down to 60%. For example, I think Barclays capped everything at 60% as a start. Certainly new business and new purchases. They all took quite rightly too, they all took a cautious stand on it. But over the last month, they have been increasing, most lenders have been increasing the loan to values. And I know TSB at the beginning of this week jumped that they'll now do 80%. I've got clients who are desperately waiting to port their current mortgage to a new place. They need 85%. I said, sit tight, we'll keep an eye on it. It will happen. We've got Halifax reduced down and they're now doing up to 85%. HSBC have been in there, I think, the whole time with the highest loan to value. They've been accepting at 90%. But
is
again,
buyer, Emily, can first time buyers get more than that, or is 90% now it as far as
90% at the moment? In fact, I've got some clients I'm speaking to tomorrow who are looking for that, and I did research yesterday, and only HSBC, sort of in terms of the mainstream high street lenders, came up. So that you can get it. So it's not saying that it's impossible at the moment, but you won't have very much choice at that loan to value. But I don't think it's looking like it's going to be long before 85% is reasonably standard again. The lender, they're creeping, but some are going to be more cautious than others.
Okay. One of the things that a lot of people now, obviously finances are tight. Some people will be thinking about equity release. Could you explain what that is, how it works?
Yes, equity release is a speciality of mine. I've been doing that since 2006. It did used to have quite bad, and still does actually, some people who don't understand it properly because of previous years ago when it came out, sort of previous bad press, because you didn't have to get financial advice, and people were just, older people were ripped off and taking on a commitment that they didn't understand fully. So it is a full advice process one has to follow. But essentially, equity release is a mortgage, but it's designed for people generally over the age of 60, although there are a few lenders who will do it from 55 upwards, but generally 60 plus. And it's aimed at people who need to release money against their homes. You can have a fixed or a variable rate interest rate, but that is usually, all the fixed rate ones I've done, the rate is fixed for life. And rather than having to make monthly mortgage payments, the mortgage interest is added to the sum that you borrow throughout the term. So say you borrow £50,000 against your house, which is worth £250,000, and you're getting charged interest of, 4%. Let me grab a calculator. So you borrowed 50,000, you're getting charged interest of 4% a year. £2,000 a year is getting added to that 50,000.
But you don't have to pay it, right?
You don't have to pay the interest. Some of them give you the option to pay it. So some people use these now as a way of repaying an interest-only mortgage. Say they're 70, 75, and they're still owing a sum against their property. They don't want to sell. They don't want to move. They want to stay in the property. In most cases, as long as the loan to value, which we'll come on to in a minute, as long as the loan to value is low and fits the lender's criteria, you can take out an interest an equity release mortgage. You don't have to pay the interest, but you can if you want to. Yeah,
that's interesting. The other thing that I find really weird about equity release mortgages is that they'll lend you a higher percentage of the value of your property the older you are, it seems. So that's kind of reverse, counterintuitive from a normal mortgage, isn't it?
Yeah, because it's calculated on an actuarial basis, because the lender, the risk to the lender is that the property is not suitable security to be sold when that person dies or moves into long-term care for the lender to get their money back. The basis is that the money doesn't have to be repaid until that the person, or the last surviving person, if it's two people, the last one of them actually dies or leaves the property to move into a care home full time.
Right.
People might sell in the meantime. You don't have to keep the mortgage until that point, but that's something that I would look into people with more detail. That's not a conversation to have now. But because they will lend, because the interest is going to add to the mortgage balance, they call it at compounding, so it adds, and then the interest is calculated on the slightly higher sum each year, they're going to lend younger people a lower percentage. So if somebody was coming to me and they were 60 or 65, you're probably looking at about 25% of the property value being the maximum that you can borrow. If someone's coming to me and they're 80 or 85, you can get near 40% of the property value. Sometimes it depends. The rates are lower. It's very risk based. The rates are lower for the lower percentages because it's a lower risk to the lender.
Yeah. Okay. And how do you see the mortgage market going forward? Do you think that these low rates are going to be with us for some time? Are you thinking that the best value now are the 2-year fix or the 5 or the 10s? What's your forward-looking perspective? I know you don't have a crystal ball.
Yeah, this is one of those ones where there isn't a right or a wrong. I mean, the 5-year fixes are super low. You can get a 5-year fix at 1.5%, now 1.5, 1.5, 1.6% at a low loan to value. And you can get a 2-year fix about the 1.2%. This is just roughly speaking. Obviously, it depends on the loan to value. Tracker rates that at the sort of below 75% loan to value, you can get similar tracker rates to the 2-year fixed rates. But most people will go for a fixed, but it depends on the individual circumstances, and all options should be considered. My personal preference, if I'm planning to stay in the place where I live for the next 5 years, I would go for a 5-year fix, because I think to fix in, having done this job since 2005 and seeing people rushing in to get a 2-year fix at 6%, just at the beginning of 2008, to fix in for 5 years below 2%, you can't really sniff at that. Amazing. But equally, some people think there's not much risk of the rates going up in the next few years. They prefer to make the saving on taking the shorter 2-year fixed rate. So it's my stance is just to present all options to the client and have a discussion and see what I can give them my opinion, and from what they've said about their personal circumstances, what I think would suit them best. But individually, it's their decision.
Yeah. And last question: are you busy right now? Have you got many applications? What's going on?
Yeah, see, I shouldn't say disappointingly busy, but really busy actually. We thought at the beginning, I think this is week 7 of working from home. And we thought a couple of weeks on catching up with everything, and then doing all the non-urgent jobs and a few inquiries coming in here and now. I think I've got 3 calls for new customers booked in tomorrow, 2 for one first-time buyer, 2 people looking to move and review what they've got, and 1 equity release lady. Lots of rate switches, remortgages going on, a couple of new purchases. So yeah, busy.
Fantastic.
And actually, I think I've done 3 with HSBC, and I'm not trying to plug them. It's just because I've done a few with them at the moment, and the desktop valuations have worked very well. And offers have come through, and Halifax as well, offers coming through very quickly. So it's still very much open for business, and looks like it's can only improve from here onwards.
Brilliant. I do have a question that's come in from Ryan Chappell, but the difficulty with it is he's been offered a 5% fixed rate on his mortgage. Should he take it? But I know you can't answer that question without further information. So I'll message you, Ryan, off air, and I can put you in touch with Emily for a detailed conversation if you want to take that further. And yes, we are.
Look at it in more detail, and just review all options before making a decision.
Absolutely.
But happy to have a chat about that.
Absolutely. Emily, you've been absolutely fantastic. Thank you so much for coming on. You are an inspiration, and we will speak with you soon. Take care.
Thank you very much, Ken. Thank you.